There's a rule in finance nobody teaches you until it costs you money. The cheapest debt in the world always comes with a bill. It just arrives late, sometimes decades late. For 30 years, one country quietly handed the rest of the planet free money. No collateral calls, no deadline. Trillions of dollars flowing out, propping up your 401k, your mortgage rate, that tech stock that somehow tripled in 5 years. That country is now asking for its money back. And almost nobody outside a finance terminal has noticed, because the withdrawal isn't happening in a bank. It's happening inside pension funds, insurance companies, and a bond market that hasn't moved this fast since before most of us were born. Stick around, because by the end of this video, you're going to understand why a retiree in Osaka might be the reason your mortgage quote changed this year. Let's start with a number that shouldn't be possible. Japan's government owes more money, relative to the size of its economy, than any developed nation on Earth, north of 200% of GDP. For context, that's a heavier debt load than Greece was carrying the year its economy collapsed. By every textbook, Japan should have gone bankrupt 20 years ago. It didn't. And the reason is almost boring. For 3 decades, Japan simply refused to let prices rise, after its real estate bubble burst in the early 90s. A bubble so extreme that the land under Tokyo's Imperial Palace was once worth more than the entire state of California. The country slid into deflation. Wages froze, prices froze, and the Bank of Japan pinned interest rates at 0 and left them there. Here's the part most people miss. When your interest rate is 0, a mountain of debt stops being dangerous. It's not that the debt disappeared, it's that servicing it cost almost nothing. Japan wasn't defying gravity. It had just found a room with no gravity in it. And there's a second reason nobody panicked. Japan didn't owe this money to the world. It owed it to itself. The Bank of Japan holds roughly half of all outstanding Japanese government bonds. Domestic insurers and banks hold most of the rest. Foreign investors own less than a tenth. When a country basically owes money to its own citizens, a bond market panic looks very different than it does in, say, Argentina. That stability created something strange, and this is where your money enters the story. Picture a composite character. Call him Hiroshi. 68 years old, retired school teacher, lives outside Osaka. Not a real person, but a stand-in for tens of millions of Japanese savers just like him. For most of Hiroshi's working life, keeping cash in a Japanese bank paid him almost nothing, a fraction of a percent, year after year. Meanwhile, the same yen sitting in a US Treasury bond paid 4 or 5 times more. So Japanese households, pension funds, and insurers, the institutions managing money for people like Hiroshi, did the obvious thing. They sent trillions of yen overseas, chasing yield. Multiply Hiroshi by an entire nation, and you get something economists call the carry trade. Borrow yen for close to nothing, convert it to dollars, and buy almost anything that pays more than 0. US government bonds, tech stocks, real estate, you name it. Some estimates put the total size of this trade in the trillions. Here's the way I'd explain it if you'd never heard the term. Imagine your neighbor lets you borrow his car, indefinitely, for free, no questions asked. You'd probably stop treating it like his car. You'd drive it everywhere. You might even lend it to someone else. That's what global markets did with Japanese money for 30 years. Nobody expected the neighbor to ever ask for the keys back. He's asking now. The trigger wasn't a scandal. It was 2020. Pandemic stimulus flooded the world with cash. Supply chains snapped. Energy prices spiked. Inflation, the thing Japan hadn't seen in a generation, showed up on its doorstep too. Every other major central bank slammed on the brakes. The US pushed rates toward 5%. Japan looked at its 200% of GDP debt pile and basically said, we can't afford to do that. So it didn't. It held rates near 0 while the rest of the world raced away from it. That gap is what broke the yen. If cash in dollars pays 5 times more than cash in yen, money doesn't sit still. It runs toward the higher yield. The yen slid from around 110 to the dollar down toward 160, a 40-year low. And Japan has almost no oil, no gas, barely any domestic energy. It imports nearly everything, priced in dollars. A weaker yen means a more expensive energy bill, which means more inflation, which pushes the yen down further. It's a feedback loop with no natural floor. Something else cracked too, something more cultural than financial. For the first time in a generation, Japanese workers started demanding raises, and getting the biggest ones in over 30 years. Zero inflation had frozen that instinct for decades. Once it thawed, wages and prices started chasing each other upward, the exact spiral central banks spend their careers trying to avoid. Japan was cornered into a decision with no comfortable exit. Try this thought experiment. You're the Bank of Japan. You have two levers, and pulling either one breaks something you need. Lever 1. Keep rates at zero. The currency keeps sliding. Imported inflation keeps eating retirees' savings, and a country built on decades of careful saving starts to feel like it's being robbed in slow motion. Lever 2. Raise rates to defend the currency. But now that 200% of GDP debt pile, the one that was safe because it was free to service, starts accruing real interest. The Bank of Japan, which owns half the bond market, starts bleeding losses on its own balance sheet. There is no lever 3. Save the currency or save the bond market. Choose. Japan tried to split the difference. A small rate hike here, a currency intervention there, and got hit with the worst of both outcomes anyway. In one stretch, Japan's Ministry of Finance spent an estimated $73 billion buying its own currency in the open market. The relief lasted about 3 weeks before the yen resumed its slide. One trader I came across described it well. Defending a currency while your whole economy still runs on cheap credit is like tapping the brake pedal with one foot while the other foot never leaves the gas. You don't stop. You just burn through your brake pads. So if buying the yen doesn't work, what does? Japan appears to have landed on a different answer. Don't defend the currency. Change where the money lives. There's a term for this in economics: repatriation, capital coming home. And for the first time in 30 years, there's finally a reason for it to happen. When Japan's 30-year government bond starts paying something close to 4%, Hiroshi's pension fund can suddenly look at a bond in its own currency, at home, with zero exchange rate risk, and think, why am I still funding someone else's mortgage market when I can get paid to fund my own? In mid-2025, Japan's government publicly pushed its giant public pension fund, the largest in the world, managing well over $1 trillion, to start shifting weight away from foreign holdings and back into domestic assets. Around the same time, data on Japanese insurers showed the sharpest pivot in years. Institutions that had been steady net sellers of Japanese government bonds flipped into being some of the biggest buyers. Here's the mechanism that connects this to your life. To buy yen-denominated bonds at home, these institutions are funding the purchase by selling dollar assets, including US Treasuries. Sell a Treasury, get dollars, convert to yen, buy a JGB. Multiply that across an entire nation's pension and insurance industry, and you have one of the largest, steadiest foreign buyers of US debt slowly turning into a seller. The US government still has to sell an enormous amount of debt every year, regardless of who's buying. Fewer willing buyers means one thing: higher interest rates to attract new ones. That pressure shows up in the 10-year Treasury yield, the number that quietly sets the price of a 30-year mortgage in Ohio, a car loan in Texas, a small business line of credit in Georgia. Hiroshi never met you. He doesn't know your name, your city, or your interest rate. But the retirement decision he's making right now is one of dozens of invisible threads tugging on the number your bank quotes you. I want to flag something honestly, because I think financial YouTube gets this wrong constantly. An anonymous account with no verified connection to Japan's central bank or government gained a huge following by posting vague, ominous predictions about capital returning home. Predictions that lined up, at least loosely, with events that followed. It even referenced an obscure, real clause buried in Japan's civil code around lending and interest agreements, framing it as a tool Japan could lean on to discourage foreign borrowers from endlessly rolling over cheap yen loans. I'm not going to pretend that account is a secret Bank of Japan insider. There's no confirmation of that, and treating anonymous social media posts as monetary policy is how people lose money. What I will say is that the underlying trend the account was riding, institutional money quietly moving back to Japan, is real, verifiable, and shows up in actual purchase data. The mystery poster didn't cause it. They just noticed it early. There's a second, quieter incentive at play too. In mid-2025, Japan passed legislation formally recognizing crypto assets as regulated financial instruments, alongside proposed tax cuts that would slash the rate on crypto gains for money that returns to onshore, regulated exchanges. On the surface, that reads like a crypto headline. Underneath, it's the same repatriation story wearing a different outfit. Another lane built to pull capital, and eventually buyers for Japanese government debt, back onto home turf. It's the same playbook stablecoin issuers use in the US, where the reserves backing digital dollars end up parked in US Treasuries. Japan is building its own version of that pipeline, aimed at its own bonds. Here's the pattern that should actually worry you, and it has nothing to do with anonymous tweets. Go back through market history and look for the moments the yen suddenly strengthened, hard and fast. 1998, right as a massive hedge fund, leveraged to the eyeballs on borrowed yen, collapsed and forced the Federal Reserve to organize an emergency bailout. 2008, all year, as the global financial crisis tore through leveraged bets everywhere. 2011, 2016, around Brexit, March 2020, as COVID panic hit. August 2024, when the Bank of Japan raised rates by a mere quarter of a point, and Japan's stock market had its worst single day since 1987, with US markets catching a real, if smaller, jolt the very same day. Every single time, a fast-rising yen showed up right as leverage somewhere in the world was unwinding violently. The yen isn't usually the cause. It's closer to a smoke alarm, a signal that borrowed money, wherever it's hiding, is being pulled back in a hurry. What makes this moment different from every one of those past episodes is intent. In 1998, 2008, 2011, 2020, nobody wanted the yen to spike. It was an accident, a side effect of panic. This time, a stronger yen isn't the accident, it's the plan. Higher domestic bond yields, public pressure on pension funds, new incentives for capital to come home. Every piece is pointed at the same outcome. That doesn't mean a crisis is guaranteed. It means the alarm that's gone off before every major deleveraging event in the last 30 years is now being triggered on purpose, by policy, instead of by accident. Nobody, including me, knows exactly how that unwinds. But it's worth understanding the mechanism before it shows up in a headline instead of a video. So here's the honest summary. For 3 decades, Japan quietly financed a chunk of the world's cheap money, including a piece of the market your own retirement account probably sits in. That era looks like it's ending, on purpose, and the exit ramp runs straight through the US Treasury market, and from there, into your mortgage rate. If you made it this far, drop a comment. Does it bother you that a pension decision made in Tokyo can move the number your bank quotes you for a 30-year mortgage? I read every one. Subscribe if you want the next video, the moment Japan's next move drops. Because based on everything in this video, this isn't over. It's just getting started.